tariff headlines continue to dominate the financial markets, and investors are having a hard time trying to figure out whether this ends well or badly. Economists continue to assign a significant chance to both US and global recession. And while President Trump's 90-day pause on the implementation of tariffs was welcomed by a wild yet temporary rally in share prices, the attitude towards China seems to be getting worse. Joining me is Xiaolin Chen, Head of International at Crane Shares in London. Welcome, Xiaolin. How are you?
Very well. Thank you for having me, Andrew.
It's always a pleasure. Let's start with the recent exclusive Wall Street Journal article that claimed that US Treasury Secretary Scott Bessent recently floated a plan to leverage better trade deals with the United States if each country agreed to isolate China. What do you make of this news story, Xiaolin?
And that's quite a mission impossible, let's put it that way, because when US negotiated the tariff deal with the whole world, it's already setting himself up to a very challenging job on its own. Now, all the other countries are agreeing to isolate China. When we use China-produced product, China trade partnership, every day in, day out for even normal households experience that. It's very hard to agree on that. I would put that as mission impossible. I'd be very amazed and truly unbelievable too for that to be achievable. If you look at China's exports over the last 2 decades, Andrew, China has been actively reducing its export reliance on developed markets. Over the last 2 decades, China has increased its trade or exports to ASEAN, to emerging markets, frontier markets, to their One Belt, One Road partners, over 28% of increase. So it shows time to time they have been diversifying that trade partnership globally. Hence, it's the challenge to say the rest of the world also decouple with this country. I think at the end of the day, maturity is needed here, also more constructive dialogue needed here. We need a plan for the world, number one, and number two, to get back to the table and agree a plan and move forward from here, period, the end.
Now, earlier this week, Trump declared that, and I'm quoting here, the ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country, except they are much larger. And then China announced that domestic airline companies should not place further orders with Boeing, the largest exporter by value in the US. Who really needs who most, Xiaolin?
We need both. We both need each other. Let's just be honest here. Regardless the numbers in nominal, in whatever the percentage, U.S. exports to China 7.5% of their proportion, where China's buying things or exporting to U.S. was only 2.3% of China's GDP. I was looking up the numbers. Surprisingly to me, the number of come up really low. The exports that China does to U.S. was only 2.3% of China's GDP. Just shows again the very diversified away from being a big partner focused to broadly diversification. But anyway, U.S. started this talk, this initiative, shall we call them? They have to have a very clear agenda. Let's have a clear agenda. What do we aim to achieve? Thus far, for me, sitting in London, watching this whole situation developing, evolving, I personally felt that's not but a clear agenda. It's quite a disorganized. What do we aim to achieve? The first announcement of the tariff announced by President Trump, Vietnam jumped on the call to say, hey, I will have 0% tariff on you. Shall we make a deal? He said, I'll call you back. Andrew, that to me is really not what you want to achieve just yet, okay? So we got to have an agenda to say, listen, we want to do X, Y, Z. That's not very clear. So far, I've not heard any progress. Maybe we shouldn't be. Maybe we will be at some point. What is the plan? What's the progress we have made with all these 70, 75 countries that has been talking to the United States? Are we making deal? Where are we? And what's the end goal? And we have suddenly a pause of 90 days to give us a time frame to get the deal done. The most important two partners in this whole world is China and the US. Okay, they have to sit down and talk. This is one way or the other. China imports airplanes. That's why Boeing gets impacted, and energy from US. Also some semiconductor, electronics products, so on and so forth. And most importantly, agriculture products. They need to feed these billions of people. That's why they have a very strong relationship, a trade relationship with the United States. Over all these years, they buy what they need. But the goal is to say, you know what, we need the art of a deal version number 2. Let's talk about it. China could potentially increase things they needed. And I found it's interesting that both sides waiting. I don't know if it's true, waiting for you to call me or I will call you first. At the end of the day, what is going to hurt immediately is the U.S. exporter, because China is going to halt to buy these agricultural products. If you increase 125%, Andrew, that's not viable to do any business in 125% tariff, period, the end. So at this effective rate, nobody can do any business on both sides, period, the end. The impact is high. I saw a few days ago, Michigan released the index on investor sentiment in U.S. It plummeted by 11%. Inflation is expecting to go up by 6%. Mortgage rate in U.S. is 7%. What are we doing? U.S. consumer will suffer a lot in the short term, which I don't think they deserve to do that. They deserve to suffer. We just need a clear agenda, be less disruptive to the markets, and clear agenda, and let's talk respectfully and get the deal done.
There are two potential additional policy tools that are possibly coming into play here, Xiaolin, and I'd just like to get your thoughts on both of them. Lately, the People's Bank of China allowed the yuan to weaken against the US dollar, and at the same time, yields on US treasuries rose markedly. Now, there's not necessarily a clear link between, we all know that China is the largest holder of US treasuries, and we don't know that the Chinese authorities or anybody in particular was selling US treasuries, but it coincided with a big jump in US treasury yields. What are your thoughts on the effectiveness of these additional policy tools that may be coming into play as the trade wars begin?
It's very important, particularly China still at the end of the day, I'm not underplay that China is an export country, okay? So currency is important. They no longer needed a cheap currency like in early 2000s when they just started to be a manufacturer for the whole world. Now they need a stable currency. So this kind of depreciation, I don't think it's deliberate, probably market movement on the different direction of interest rate movements as well. US we're not sure where Fed going to be. The expectation was high to cut, but now if inflation, and there's a lot of contradictory message flying around, so it's very hard to decide. But in China, it's very clear. They cutting rates again and again for 9 quarters by now. So interest rate direction in renminbi is more clearly one way. It's going to be more cut. So renminbi got to depreciate somehow. And then China is and does still hold over 800 billion, probably 850 range, 800 to 850 range of US treasuries. Market is trying to get out. Are they trying to hurt the US bond market? I sincerely think so far, at least the announcement, because once you trade, you announce, it's not coming from China, so they're not dumping the US treasury. They could, as the largest shareholder of a US treasury, they could, but they chose not to, which is, I think, is quite rational and mature in the way of dealing in the financial market. That's one. And second, I think it was quite this time around, I think surprised me, also surprised a lot of the investors, is also, it seems at the same time when US equity are having a tough time, US bond market having also a tough time, US dollar also having a tough time. A lot of people calling this US exceptionalism, probably diminishing, which I felt somehow proved to be the truth. Because usually we have a moment say, you know what, let's sell and ask question later, and next you buy with your cash is US dollar. This time around, we didn't see that trend happening. That's market being slightly taking a bit of a conservative approach to say this is somehow a manufactured volatility introduced to this market. So we got to watch and decide what is the next step before this is going. But I think if you look at policy, domestically, China have very accommodative monetary policy, physical expansion, credit markets picking up, consumer stimulus package is on the horizon. They claim they're going to do 2 trillion this year to help the consumer. So I think they're going to front load a lot of those policies in the coming weeks to make sure that can counter offside certain of the downside risks that this trade discussion is still happening. With US, I sincerely hope we need a very clear agenda. We need to know how the government acts in conjunction with Fed. Please talk to each other. so they can coordinate it better with the market. Because U.S. investor does not deserve this kind of volatility. Not at all. Most U.S. investors are very long-term, very mature, as household holding the U.S. equity market. We need certainties. Even if there's a risk, we need to know why and where it comes from. Not in this all of a sudden, here you go, my executive order of the trade tariff and talk with the rest of the world. I hope U.S. will have a big announcement and agreements with some countries, so at least they make progress on this trade tariff.
Talking of volatility, Xiaolin, how have Chinese stock markets held up during this tariff turmoil?
Relatively well. If you look at just absolute performance, they actually outperform in a single digit to the rest of the world. But that's really due to a couple of reasons. One, fundamentally, Andrew, those stocks are very cheaply valued over the years. Okay, their valuation is really at a very attractive level, one. And second, those corporates are actually climbing up back to their pre-pandemic profitable level. And you could say, hold on, but will this trade talk will impact their revenue? And surprisingly, I'd say some names that is very well known in the U.S. investor space because they listed in New York Stock Exchange or NASDAQ, they listed in the U.S. like big Chinese e-commerce companies, Alibaba, Pinduoduo, Tmall, all those companies collectively there's an index called CSI China Index, have all these names in one index. You do analysis that shows China e-commerce company holistically, their revenue generated outside of mainland China is at 1.87%, less than 2%. So Chinese companies are less exposed to external shocks than we thought. So those companies hold up quite well for a couple of reasons. Valuation and profits are climbing back up. And third, they're themselves buying their own stock, saying, hey, I squeeze in my futures, it's fine, show me money. They have been issuing a lot of share repurchasing program, each individually of them, for a long period of time. They continue to do. And they give you one more point, which is very important. The national team, they call them a Chinese national team. It's really just a combination of pensions and some state monies and big insurance companies in all conjunctions of a couple of big institutions doing that together. They are buying. Okay, they introduce this market stabilizing fund, about a few trillion, and every time they buy, they will tell the market they bought it after the fact. And then during this turmoil, what they did, it was like, listen, at this value, we are buying. And they made the announcement. So that gives confidence to local investors. One, we are actually less exposed to external exposures to exports. And then we have the backup from the government team. So the markets actually hold up relatively well.
My guest has been Xiaolin Chen, Head of International at Crane Shares in London. Thank you very much for joining me, Xiaolin.
Thank you, Andrew.
And a reminder to our listeners, if you enjoyed today's episode, please consider subscribing wherever you get your podcasts from. Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.